Hi guys. Right. So this is how I hope to kind of go through some chapters that I think are quite wordy and where there's not too much of a calculation. I will still talk about it in class, but at least this gives you a bit of a heads up. So this is chapter 5. Right, 1 second. Let me just get the pen there, and it'll wake up in a second. Right, there we are. So let me just make that. Bang. Where are we? Right, here we are. So income from self-employment. That's what this is talking about. So we're talking, if you like, about someone, usually an individual. It could be just working on his own, but this is not the company, of course, right? So we have an individual working as a sole trader. Now, of course, he might, be employed on the side, so to speak. But fundamentally, we're talking about his self-employed income. So this is income he has to declare, if you like, by January the 31st, if you like, every year. So the issues here are, we're going to talk about this question of the basis of assessment, and when we get there. And we will sort of really try and discuss very quickly in this first video about what defines you as a sole trader. When can we say that you are trading? And it's not just something, it's not a one-off, it's not some sort of sale of a gift, if you like. And then, of course, later on, we will see how we work out this idea of your tax-adjusted trading profit, and talk about when we can bring in, if you like, so for example, imagine that you had just been trading, or you had been accumulating stock for quite some time, and then you now decide to trade. I mean, I can answer this already. You have 7 years to bring that, to bring the costs, if you like, prior to you now declaring yourself to be trading, or for you to be actually trading. You have seven years of time to bring in anything you've spent, if you like, all the costs that have been incurred. So it could have been some advertising, or you set up a website 5 years ago, but you haven't quite used it, and now you've started trading on that website. So you can bring in the cost of that into the accounts for the first year of trade. And we'll talk about this idea of a cash basis. And really, this is about simplicity. The cash basis is sort of saying that these sole traders don't have time, and they don't really understand capital allowances and all this capitalization. So we're just looking, the government is just sort of almost looking for a way to make things simple, to enable the client to just put through everything as an expense. So we'll look at that. We'll see that as well in this chapter. Great. So that's kind of the heading. So what are we talking about? This is really talking about income from self-employment. I'm going to always have to pull my pen out to do that. Okay, here we are. So we're talking about income from self-employment. We're going to talk about, again, like I've already mentioned, what defines you, or what defines a trade. And then we'll discuss this issue of trading income. And of course, I just talked about pre-trading expenditure. And then we talk about adjustments and, of course, the cash basis. So trading income. What is trading income? So like we've talked about employment income, that comes from your, of course, day-to-day work. Trading income is you are selling something or selling a service of sorts. So it's really the profits of an unincorporated, so you're not a company, arising from a trade, profession, vocation, if you like. So you're in control, really, of this thing. You're not being, this is not PAYE. And so typically individuals in unincorporated businesses are referred to as self-employed or sole traders. Now, here's the thing. You and I know that sole traders can employ people, right? That's very possible. They're just not registered, if you like. So the sole trader himself is just not registered as a company, but you can employ people. And those people you employ, you could treat the same way we've treated people in chapter 4, 3 and 4, where you would pay them a salary, do their national insurance, do their PAYE, but you yourself, if you like. And typically we'll see this a lot. This happens a lot with, of course, accounting firms, or although many of them becoming limited liability partnerships, but a lot of partnerships are just really made up of sole traders, fundamentally, right? So let's quickly scroll down and let's go further down. Yes. So now here's the thing. We want to allow people trade. So typically, of course, people will prepare their accounts for 12 months. Now, you and I know, if you remember, that sole traders are not obliged to even prepare accounts, really, because they're not sending them off to anyone, technically, but they do, right? And typically, if they're going to grow, they have to stick to a 12-month period. So you are free, if you like, to prepare your accounts however it works for you. So you could prepare your accounts, I don't know, from the 1st of January 2017 to the 31st of December 2017. Well, for us, if you like, as accountants, for the government to sort of see how they analyze this and almost try and work out what rules will apply to you, we need to decide, if you like, what Finance Act, if you like, would apply to you. And the way it's decided really is that you can see here, it is assessed on what's referred to as a current year basis, and if you like, this means that profits are assessed in a tax year. The profits assessed in the tax year are those of the 12 months ending in the tax year. We know what the tax year is. I'm just going to change my pen color. So the tax year is the 6th of April to the 5th of April. So in this scenario, we will have change. So we will have, if you like, the end of the tax year is the 5th of April 2018. So really, you have the Finance Act, well, FA 17, which applies to the tax year 17 ending in 18. So, if you like, the rules, if you like, that apply in that, if you like, financial year would apply to this business, for example, because it ends in the tax year 5th of April 2018, and that's how we deal with this. We'll see a bit more of this when we move on, if you like, to chapter 7. Okay, great. So what do we have here? Yes, again, so really the question here is that this thing you're doing, is it a trade? That's fundamentally the first question. Is it a trade? Now, if it's a, is it a trade? Now, it's a one-off, you know, if you had a I don't know, whatever it was, something at home on eBay, say, so for example, a pair of jeans, and you just wanted to get rid of them, and you got rid of them. That's just a one-off. That's not a trade. And really, it's not even considered capital gains, because it may be, depending on if you bought the jeans for £10 and sold them for, I don't know, £1 million, and the government will be like, that looks like a capital gain. But we'll talk later on about what we consider to be assets or chargeable assets to capital gains. We'll talk about that later. But a pair of jeans and things like this that are typically under £6,000, totally irrelevant. No one cares. But most of the time, those one-off things are irrelevant. The key point here is that for things that are considered to be trade, the profits are treated as trading income. So we have a number of tests known as your badges of trade. And of course, again, typically you can argue that yes, that any venture, this idea of your intention is to make profit, so to speak, we can consider, if you like, to be trade. Now, as you can imagine, you will have a lot of case law on this, but there are some fundamental guidelines. Nothing is conclusive. You still have to go to court if you don't want to consider it a trade and prove that it is not, if you like. The burden is on you to prove that it is not a trade. But generally, HMRC will look at two areas. This acronym referred to as SOFIRM and FAST, right? So what does that mean? So these goods that you're dealing with, are they normally typically used, if you like, in trade? Can it be traded, if you like? And of course, the length of the ownership. So if you're holding it for a short period of time and getting rid of it, if you like, well, then typically that might be considered a trade. If you've had something for a long period of time and then you sell it, that might be considered a capital disposal. And that might be subject to capital gains, if you like. Frequency, so this is how regular are you doing this thing, you know. And of course, did you have to add value to it? So for example, did you buy some raw materials and then if you like, stitch it up and play with it and add some extra labor to it before selling it? The degree to which you've done that. And then we have, of course, let's go on to the next page. Right. So the circumstances. So of course, if you were trying to raise money for whatever reason and you had to sell an asset of yours, if you had to sell your laptop because you needed some money urgently, that's not a trade, if you like. It has to be something regular. But again, this probably this issue of and the lawyers are trying to prove that if you intend on making profit, this is probably the biggest one, the intention to make profit, if you like, on a regular, frequent basis with goods commonly associated with trade. Now, those are your fundamental ones so far. And then what you also have is a couple others called, if you like, fast to help you kind of decide. If you, typically we know A is equal to C plus L. If you have a sort of situation where you've taken out there's some L to help you with A, and then you take that A and then buy some goods and then get rid of the goods to make profit. This idea of taking out money to buy goods pushes us to really think that it is looking like a trade. Because you hadn't just had it for a long time via C, if you like, and it wasn't gifted to you. Again, like what I've just said, because it wasn't gifted to you, you had to buy the thing, and because you had to buy it and then resell it, chances are we're thinking that's a trade. And then finally we have here existence of similar trading transactions. So if this is kind of happening regularly, we start thinking, yes, this is a trade. So you can see there is no one-off. There's no one thing that defines it all. But it's really a mixture. It says it's an overall impression, taking into account these relevant factors. Okay, right. And really, these next couple of pages just kind of go into what I've just talked about in a bit more detail. So this is just extra reading, giving you kind of some, if you like, of so far of badges of trade. So really, take some time and just read through all these. But they're just really further detail of what's going on. Again, I'll just be repeating myself, if you like, there. And it's the same thing here as well. It says for F, for example, where it was necessary, where you had to take a loan out, for example. You have to take a loan out, for example. So we know that that's something. And then method of acquisition, like I said, if it's gift, and that's kind of that. And this video is coming to an end very soon. Yes, exactly. So I'll end there for this.